It's fair to say the UK hasn't been the best market for growth in recent years, but what it does have is a reputation of producing strong dividend-paying companies, mature companies that may not grow the quickest, but pay out consistent and growing dividends to shareholders. So today I'm comparing 3 UK dividend ETFs. These shouldn't be the only holdings in your portfolio. The UK isn't really big enough to be truly diversified, but as part of a wider portfolio, these can be great income tilts. We'll start with the most popular, the iShares UK Dividend ETF. It has the ticker IUKD and the TER is 0.4%. The fund is up a massive 25.86% year to date. That's including dividends. And the dividend yield is currently sitting just over 4%. I did look at this fund earlier in the year and had a dividend yield closer to 5%. And that reflects how much the capital has outperformed the dividend growth in recent months. It's obviously unrealistic to expect 25% growth year on year. So if those companies continue to pay growing dividends, then that yield could increase as the dividend rate starts to catch up with that capital growth. The ETF tracks the FTSE UK Dividend Plus Index. That's an index that tracks the highest yielding UK stocks in the FTSE 350. That's the largest 350 companies in the UK by market cap. On one hand, that theme has meant it's performed exceptionally well over the last 5 years. It has an average annualized return of 15.6%, but that also creates somewhat of a risk going forward because by only focusing on companies that pay the highest yields, it ignores the quality of that company and dividend. If a company has a particularly bad year, it may want to still maintain its dividend because it wants to keep its shareholders happy, and it may even want to incentivize new investors. But if there's something fundamentally bad happening within a company, that means it's performing badly. Just because it's got a high dividend yield doesn't mean it's in a strong financial position. And this index weights the companies based on its yield, rather than its market cap, which a typical index might use. Cost-wise, it is relatively expensive at 0.4% TER, especially when you compare that to a more standard style ETF. Has got a very large size though. This fund in particular has an AUM over £1 billion, so there should be no liquidity issues. It's from iShares as well, so you've got the reputation behind the fund. If you want a fund that puts more focus on the quality of dividends, then this next fund could be for you. It's the SPDR S&P UK Dividend Aristocrats ETF. It has a ticker symbol UKDV and has a TER of 0.3%. The unique benefit to this ETF is in the index that it tracks, the S&P UK High Yield Dividend Aristocrats Index. The index sets out specific criteria that every company has to meet in order to be included in the index. For example, stocks must have increased or maintained a stable dividend for at least 7 consecutive years. Companies also can't have a dividend yield over 10%. Over 10% is deemed not sustainable long term. And they also can't have a dividend payout ratio of more than 100%. So that means it can't pay out more in dividends than it has actually earned. So some companies will actually go into debt to continue to pay a dividend because one, they want to keep their shareholders happy, and they may want to incentivize new investors. So for a short period of time, they'll pay out more than they've actually earned. And obviously that's not sustainable long term for a company. The companies must also be of a reasonable size with a market cap valued at over $1 billion. And to ensure diversification across the index, the weighting for each company is capped at 5%. So you can't have too much concentration in a small handful of companies. So with this criteria, as you would expect, the dividend yield is slightly lower at 3.75%, but it still had a reasonably strong year performance-wise. Year to date is sitting at 13.72%. That's including dividends. And that criteria also means there's only 40 holdings in this ETF. I will compare these stats side by side, but there's one more that you may not have considered. This is the iShares Core FTSE 100 ETF. It has the ticker symbol ISF and it has a TER of 0.07%. And while this ETF is not specifically focused on dividends, because UK companies tend to be more dividend focused rather than growth focused, like tech stocks, this can still act as a decent income tilt. It has a slightly lower dividend yield compared to the other two funds at 2.54%, but its main benefit is its size and cost. At 0.07% is way cheaper than the other two. And this ETF is also massive, over 13 billion in AUM. One of the main reasons you would go with this ETF over the other two is the dual purpose of having UK exposure and decent income. You may already have the accumulation version of this fund in your wider portfolio, so if you wanted to turn income on, all you've got to do is switch share classes. Just before we look at these side by side, I wanted to let you know that I've just launched an investing community called the Investing Hub, a place to chat all things investing and personal finance, and while learning from like-minded individuals. Check it out using a link down below. Let's put these ETFs side by side. This is looking at performance over the last 14 years, and they performed how you might expect, with the FTSE 100 being the top performer, the iShares Dividend Fund coming in just below it, and then the Aristocrats Fund being the lowest. That's the price you pay for those quality dividends. But over a slightly shorter time frame, it's actually a different story, and it's turned out by focusing on dividend yield, the iShares Dividend Fund has actually outperformed a typical FTSE 100 fund. One thing to note on the dividend frequency is that the FTSE 100 and the iShares Dividend Fund both pay out quarterly, where the Aristocrats Fund pays out only semi-annually. So that could be an important consideration. What's interesting looking at the holdings for each of these funds is, as you would expect, the two dividend-focused ETFs have a smaller number of holdings, which you'd expect to then have a higher concentration. But because the FTSE 100 is market cap weighted and it has such large companies, its top 10 is actually a higher concentration, with its top 10 making up just over 45%. It is slightly more spread out from a sector perspective, and you can see in the iShares Dividend Fund, financials make up just over 31%. Having said that, financials are the top in each of the three funds, and historically, they've been very strong dividend payers. And they performed very well since interest rates have increased in the last few years. Another standout across all three ETFs is consumer staples, and this is a key trait of a dividend ETF. These companies tend to be more stable because even in downturns, people still need to buy these types of products. They tend to have smaller R&D budgets, and they prefer to pay their profits out to shareholders rather than reinvest that back into the business. One thing to take into account when looking at the top 10 holdings is you get an idea of the type of companies in each ETF. And this is important because you don't want too much overlap in your portfolio. For example, say you're looking at one of the two dividend ETFs. You may already have exposure to the UK, either via a global index, or you might even have the FTSE 100 as well. So by adding on this dividend-focused ETF, we could be increasing our exposure more than we're comfortable with in a small handful of stocks. In a global ETF, it's not too bad because the UK makes up a relatively small percentage, but you could have the FTSE 100, or you could have a more active style portfolio. For example, in my SIP, I've created my own global portfolio where I've picked out 6 different regions, and then I've chosen my own weights. And for me, I've decided to slightly overweight the UK compared to a typical global ETF. So if I was then to add a UK dividend focus ETF as well, I might increase that exposure too much for what I'm really comfortable with. It's important we look at dividend yields because this is the main reason why we're looking at these types of ETFs. But it's important that we don't put a sole focus on them. And this is because, one, they don't tell the whole story, but also how much they can move. Like I mentioned with that iShares dividend fund, that dividend yield has actually come down quite a lot. That's because the capital growth has been so extreme. So if all the companies within an ETF were to maintain its dividend and the share price continued to increase, that yield is only going to come down. And if you just looked at the yield, you would see that yield coming down and then may assume it's not performing that well, when actually when you look at total return, it's done extremely well. And that 4% is after the fund has done 25% year to date. So as you might expect, if that performance comes closer to its longer term average, it's likely that yield could increase. So really with these three ETFs, it comes down to what you want from your investments. If you want dual purpose of having UK exposure and an income tilt, then a simple FTSE 100 ETF could be the best one for you. If you want the highest yields, then the iShares Dividend Fund is the best bet. But if you're happy taking a slightly reduced yield to increase the quality of the company and the consistency of dividends, then that's where you go down the Aristocrats route. You can compare them by cost, but to be honest, I wouldn't put too much emphasis on their cost. All these performance figures and these dividend yields have already had that cost extracted from them. Generally, a TER is taken from the income from the fund. So when you see that dividend yield, it's already had the cost of the fund taken from it. So when you're looking at past performance and yields, you're looking at it on a level playing field. And I think you should give a stronger priority to the other reasons why you want a specific ETF. Let me know your thoughts down below in the comments. If you want to compare dividend investing with growth investing, then check out this video for an in-depth look. Thanks for watching, and I'll catch you in the next one.